Welcome to TalkTickers. You're here because you want to cut through the noise and understand what really matters in finance.
And today we're diving into the recent first quarter 2025 earnings call for Brookfield Infrastructure Partners, or BIP.
Exactly. Our goal is pretty simple. Give you the essential insights, their financial health, the strategic moves they're making.
And how management sees the current economic picture.
Right. All without wasting your time. So let's get straight into it. How did BIP kick off 2025?
Well, they had a pretty solid start to the year, actually. Funds from operations, FFO, that hit $646 million.
$646 million. And how does that translate per unit?
That works out to 82 cents per unit. But what's really notable here is the underlying strength.
Okay.
That FFO figure, it represents a 12% jump year over year. That's after you normalize for, foreign exchange impacts.
Ah, okay. So the core performance was strong.
Exactly. And ahead of their own targets, too. Now, just comparing directly to last year, the overall results were up about 5%.
Got it. So 12% adjusted growth is definitely significant. What were the key things driving that? What really pushed them forward?
Yeah, several factors really lined up for them. A big one was inflation indexation.
Right, those built-in adjustments.
Yeah, a lot of their contracts are linked to inflation, so as prices went up, so did their revenue. It's kind of a built-in hedge, which is pretty valuable right now.
Makes sense. What else?
They also saw higher revenues across their critical infrastructure networks. Think utilities, transport, data. Plus, they commissioned over $1 billion worth of projects from their capital backlog.
So those started earning money.
Exactly. They came online and started contributing. Contributions from acquisitions, those tuck-in deals they did also helped. And then finally, increased utilization in their midstream business and strong contracting in data centers.
Okay, so it really was a mix of things, not just one single driver, across the whole portfolio.
Pretty much, yeah.
All right, let's break down the individual segments then. How did each part of the business perform?
Sure. So looking at utilities first. FFO, there was $192 million, slightly ahead of the prior year.
All right.
But if you adjust for currency and some capital recycling asset sales, it was actually up 13% year over year. So healthy growth.
Right, 13% adjusted. And transport, that's a big chunk for them.
It is. Transport FFO came in at $288 million. Now that's down from $302 million last year.
Oh, okay.
But again, normalized for FX. And it was basically in line with the prior year. What happened there was some volume contraction in rail and ports.
Right.
But that was offset by record utilization in their global intermodal logistics, the container business, and also higher volumes and rates on their toll roads.
Got it. So puts and takes within transport. How about midstream?
Midstream, which is mainly energy infrastructure, pipelines and such, FFO was $169 million. That's up 8% year over year, again, adjusted for capital recycling and FX.
Saw growth there too.
Yeah, driven by strong volumes and pricing, especially in their Canadian diversified midstream operations.
Okay. And lastly, the data segment. That's been a focus area.
Definitely. And it showed impressive growth. FFO hit $12 million. That's a 50% increase year over year.
Wow, 50%.
Yeah, really strong. That came from organic growth in their existing data center platforms, but also the tuck-in acquisition of that India Tower portfolio kicked in.
Right, that acquisition effect. Okay, that gives us a good picture of the different segments. Now, you mentioned capital recycling. They're always buying and selling assets, right? What's the latest there?
Yeah, they're very active in capital recycling. It's core to their strategy, really. Sell mature assets, reinvest in higher growth opportunities.
Makes sense.
So year to date, they've secured $1.4 billion in sale proceeds. And they seem pretty confident about hitting their target of $5 to $6 billion in asset sales over the next couple of years.
And any big deals closed or announced recently?
Yes. A key one is the agreement to exit their Australian container terminal operation. That's for $1.2 billion, netting about $500 million to BIP. They held that for 9 years, got a really strong return, 18 times EBITDA multiple, 17% IRR, almost 4 times their initial capital. Pretty successful exit.
Sounds like it. Anything else?
They also completed the sale of a minority stake in their contracting containers within that global intermodal logistics business.
Yeah.
That brought in over $120 million net to BIP.
Right.
And they're on track to close the other announced sales soon. That includes part of a U.S. gas pipeline, about $400 million net to them, and an initial stake in the European hyperscale data center portfolio.
Okay, so the selling side is active. What about the buying side? That Colonial Enterprises deal, the big U.S. pipeline, that certainly stood out.
Yeah, the new investment pipeline looks robust. That $9 billion acquisition of Colonial Enterprises is definitely the headline grabber. It's the largest refined products pipeline system in the U.S.
And BIP's share.
Their equity investment is expected to be around $500 million. They're expecting it to close in the second half of this year.
And why Colonial? What makes it attractive for them?
Well, it fits their energy investment criteria really well. It's got strong utilization, a very competitive market position. They're buying it at what they see as below replacement costs, around 9x EBITDA multiple. Plus, it's highly cash generative, like a 7-year payback period.
Okay.
And importantly, they feel they paid minimal value for potential future growth. It's got a stable, resilient cash flow profile linked to inflation and a transparent regulatory framework. Ticks a lot of boxes for them.
Right, a classic infrastructure play for them, it sounds like. Now, shifting gears a bit, the global economy feels, well, a bit uncertain. Tariffs, trade tensions. How does BIP see itself positioned in all that?
Yeah, management addressed that. They believe their business model offers a sort of degree of insulation from the direct hits of tariffs.
How so?
Because their core business is owning large-scale essential infrastructure. They charge usage fees, right?
Okay.
They're not really producing or selling goods that get tariffed directly.
Okay, that makes sense. But are there indirect impacts they're watching?
Absolutely. They are aware of potential second or third order effects like inflationary pressures, but they generally expect to pass through increased costs, either through contracts or just the pricing power of their assets.
Right.
Their transport segment, which is about 40% of FFO, obviously has the most direct link to global trade.
Sure.
But even there, they highlighted that a lot of the cash flow is locked in with long-term contracts. Think diversified terminals, U.S. LNG export facilities with take-or-pay contracts.
Got it.
And their global intermodal logistics, the container business, has something like a 7-year weighted average contract term, high utilization, and some flexibility to resize the fleet if needed.
Okay. And what about costs for building new projects?
They view input costs for capital projects as manageable. They use diversified supply chains, source locally where they can. And interestingly, they also pointed out that market uncertainty can sometimes create opportunities.
Ow.
Well, it can sometimes allow them to acquire high-quality assets at maybe more attractive valuations if others are hesitant.
Right. Turn volatility into opportunity. Okay. So looking ahead then, what are their main priorities for the rest of 2025? What's the focus?
Their main focus seems to be sticking to the strategy and just executing well, especially with all the market turbulence around trade and tariffs. They really emphasize their strong balance sheet and those stable, contracted, inflation-linked cash flows as giving them confidence.
And what are the key objectives?
They laid out 3 primary business objectives. First, deliver organic growth, get those new capital projects built on time, on budget, and then keep replenishing the pipeline with high-return, lower-risk opportunities. They mentioned diversifying supply chains and using turnkey contracts there.
Okay, that's one.
Second, advance that large pipeline of new investment opportunities, taking a long-term view, acting boldly when needed. They see megatrends like digitalization, decarbonization, and U.S. onshoring driving a lot of these opportunities.
Right, those big themes.
And third, deliver on that big asset monetization target, the $5-6 billion over the next 2 years to self-fund new investments. As we said, they've already secured $1.4 billion of that.
So organic growth, new investments, and funding it through sales.
Exactly. They sound pretty confident they can achieve these, citing their consistent capital allocation approach and their experienced management team.
Okay. Now, earnings calls always have that Q&A session with analysts. Were there any particularly interesting nuggets that came out of that?
Yeah, definitely a few interesting points. They talked about their flexibility, being able to shift M&A and asset recycling focus depending on where the best global opportunities are. Right now, they're seeing a lot in the U.S., but they'll adapt.
Makes sense.
On taking public companies private, their view is it's usually driven by company-specific issues like poor liquidity or bad balance sheets rather than just a general market downturn. Conditions now are maybe slightly better for that than last year, but not hugely different historically.
Okay. Anything on data centers?
Yeah, demand seems consistent on the retail colo side, record bookings actually. And they have a significant backlog in hyperscale development. They suggested a pullback by one hyperscaler might actually make the market a bit more disciplined while others keep growing.
Interesting. And the Intel joint venture. Any impact from Intel's own spending changes?
Apparently not. They said the JV is progressing as planned, not affected by Intel cutting capex elsewhere, and they actually just refinanced the JV's debt with better than expected credit spreads, which de-risks things and should help returns.
Good news for them there. What about the Triton container acquisition? Why do that?
The rationale was basically high utilization, like 99% plus, and long contract durations over 6 years on average at rates above the current market. So it's just a more accretive way to get capacity than building new boxes right now.
Got it. Even with the China-US trade slowdown.
Yeah, they're still seeing demand. Those long contracts help, and they're recontracting at good rates. Seems customers are holding on to containers, maybe expecting future goods movement.
Okay. And you mentioned onshoring earlier. Did they talk about specific opportunities there?
They did. They see potential investments driven by U.S. manufacturing, onshoring transportation, utilities, energy infrastructure, maybe similar to the Intel JV model.
Right, co-investing.
Yeah, particularly in critical industries like semiconductors, batteries, solar panels, also opportunities at ports and in energy infrastructure like LNG. Their North American rail business could benefit too, and their Canadian energy assets are well positioned for shifting energy flows.
Okay. Any other Q&A highlights?
They confirmed their NEBC Connective Pipeline project is backed by contracts, not just speculation. They see the medium-term outlook for gas staying strong due to demand from data centers, electrification, LNG exports. They given no comment on any specific market activity, like taking small stakes in public stocks recently.
Oh.
And overall, they just reiterated the deal pipeline is strong and deep across segments, maybe slightly weighted to the U.S. currently, but opportunities are there in Europe and Asia too. Digitalization is key, but also large traditional infrastructure and transport.
All right, that covers a lot of ground from the call. Now, for our favorite segment, this is not financial advice, but, we like to brainstorm some, let's say, interesting ideas based on what we've heard.
Always fun. Okay, disclaimer firmly in place.
Okay.
Here's a thought, playing on that digitalization theme and BP's focus.
Let's hear it.
Okay, consider a pairs trade. Go long a basket of maybe smaller, niche, publicly traded infrastructure REITs focused purely on digital infrastructure. Think like specialized data center operators in maybe emerging markets or companies owning fiber networks in underserved areas, places BIP might eventually look.
Okay, long niche digital players. What's the short side?
Short a basket of more traditional, perhaps slower growth infrastructure companies. Maybe ones heavily reliant on, say, mature technologies, or maybe cyclical trade volumes that could face pressure from deglobalization or just slower growth compared to digital.
So the thesis is?
The thesis is basically that the unstoppable growth in data will disproportionately benefit these focused digital players. They might even become acquisition targets for someone like BIP down the line. Meanwhile, the more traditional side might lag. It's a bet on digital being the future of infra.
Interesting. A bet on the evolving nature of infrastructure itself. Got another one.
Okay, one more. Given BIP explicitly mentioned acquiring high-quality energy infrastructure, especially pipelines, at attractive valuations like that NIMIC EBITDA for Colonial.
Right.
You could theoretically look for a publicly traded midstream energy company, maybe one that looks like a potential BIP target good assets, maybe trading at a bit of a discount to that 9x multiple BIP seems comfortable with.
So a speculative M&A play.
Exactly. It's purely speculative, betting that BIP or someone similar might see value there and make a move. High risk, obviously, but plays directly off their stated strategy.
Definitely speculative, but based on their recent actions. Fair enough. Those are some creative angles.
Just food for thought, of course.
Yeah.
Not advice.
Absolutely. Well, that's a pretty comprehensive look at Brookfield Infrastructure Partners Q1 2025 earnings call. We've covered the financials, the big strategic moves, the outlook.
Yeah, from the solid FFO growth, adjusted for FX, to the big Colonial acquisition and the ongoing capital recycling. We hope this deep dive gave you a clearer understanding of the key takeaways.
Think about their active portfolio management, their bets on digitalization and onshoring, and how they're navigating, the current economic uncertainty.
What stood out to you? What further questions do you have about BIP strategy or where they might be headed?
And consider those bigger trends: infrastructure, technology, global trade. How might they reshape the investment landscape in the years ahead? Something to chew on. Thanks for tuning into this deep dive on TalkTickers.